We are told that price is fractal, and this will waste your time. And if you believe it to its utter extent, it'll more importantly waste your money. Here's what's going on. If you take a look at charts, for example, let me show you some charts here. People will say, you don't know by looking at this chart if it's a 1 minute chart, a 10-minute chart, a daily chart, and you may not be able to tell by looking at it. Is this an Apple stock? Is this um, an NQ indice? Is this gold? Is it one of the metal charts? You have no idea what time frame, what kind of chart it is, just based upon looking at it. You might be able to tell if it's moving what you might consider normal versus something more erratic because it's looking like it's after hours. But beyond that, you really are unsure. So then, because of this, we're told price moves the same way across, no matter if you're zooming in or zooming out. Um, the price is fractal. It will repeat the same patterns, the same uh, technical uh, patterns will show up again and again, and it won't matter which time frame you're on. To which I would say, hold on, maybe an analogy would be helpful. Uh, Picture two cousins that are related to each other. Their parents are siblings, and yet, while they might be closely related to one another, maybe both cousins are very light skinned, for example. Maybe both cousins have red in their beards, but then that's where the similarities may end. It might be that one cousin is very shy and quiet. The other cousin is very loud and boisterous. It could be one's very tall while the other one's medium in height. One's heavier, one's lighter. So they may have similarities. You might be able to tell they're related, but then you can't take it much further than that. This is where I think we see price rhymes all over the place. We find that price will behave similarly, but if you have a very technical pattern, then you won't be able to necessarily apply that just from one chart in one time frame easily to the next with at least confidence. You would need to backtest this, and that is what works. At the end of the day, what truly works and what you must do is stick with one time frame, one chart, and then begin to build confidence in that one before you hear some guy's idea where he says on a video, for example, I use this on a certain time frame on a certain chart, and you like this other time frame, you like this other chart, and so you're just going to apply this without doing any testing to see does it continue to work well. Take a look here at this example. So I'm looking at an ES chart here, and what you'll find is there's equal highs and equal uh, um, peaks that are happening. One's around, I think, 8:25 or so a.m., and then the red arrows pointing at the place I want you to really notice, which is almost 9 o'clock there. Notice how they're almost equal high before they dip down. It sells off again. It looks like there was a push, and it wasn't able to overcome the sellers, and so it sold back off there around 9 o'clock. This is on the ES. Now, if I look at the NQ, this is the exact same day, the exact same moments. You can see the rise that happens at 8:20, where it comes above the 14 EMA and then sells off, and then again another push. But notice the difference. This is why price is functioning different here, where it actually goes higher than the 8:25 time frame. At this 9, it goes significantly above. So if you took a trade setup that would have worked perfectly fine on ES and then applied it without backtesting, without knowing how the market functions in different places, well, then here you would have been blown out of the water if you were expecting it to immediately sell off at that point because it rises higher. Or maybe you had some other trade setup in mind. And this is where, again, doing the testing and sticking with a particular time frame a particular market until you gain complete confidence in that, and then see if it rhymes or needs adjustment. The last major place I'll encourage you to look when making adjustments, when moving from different time frames or moving to different stocks or different indices, is to consider ATR your friend, the average true range. This is where, based upon how a particular market moves, a particular stock, say you're looking at Apple versus Tesla, or you're looking at NQ versus the ES, you may find that using the ATR will be your best friend, because perhaps the rhyming is similar, the setup is very much the same, but the adjustment that needs to be made is that your stop on a more volatile indice like in Q, maybe your stop needs to be greater and your take profit needs to be greater, in comparison to what you would do on the ES. Or if you're moving to a different one, maybe you need to shorten that take profit zone, or tighten up your stop based upon the way the particular character and the particular personality of that stock or indice or uh, forex pair that you're trading. So take a look at sticking with that, and remember that price rhymes. It's not exactly fractal.